Hello, and welcome to Virtual Investor Conferences. My name is Cecilia, and on behalf of OTC Markets, as well as our co-hosts, Murdoch Capital Partners and TAA Advisory, we're very pleased you've joined us for our next live presentation from Karora Resources. Before I introduce our speaker, please note you can submit your questions for the presenter in the question box to the left of the slides. Additionally, all today's presentations will be recorded and available for 24/7 replay. At this point, I am very pleased to welcome Oliver Turner, Executive Vice President, Corporate Development of Karora Resources, which trades on the OTCQX Best Market under the symbol KRRGF and on the TSX under the symbol KRR. Welcome, Oliver.
Thank you very much, and good morning or good evening to everyone, depending on where you're listening from. Looking forward to bringing you through the Karora story. We'll be walking through some of the background on the company for those of you that are new to the story, and then, of course, some new market updates we've had since we've been on this platform last. And at the end, we'll have some time for some questions submitted by the audience. So I'll direct everyone's attention to the slide deck here. In summary, this pretty much captures what we're doing at Karora Resources. We're in a tier 1 jurisdiction. We are expanding our gold production from about just over 100,000 ounces last year to 200,000 ounces a year, approximately speaking, by 2024. We also have tremendous nickel byproduct credits, which I'll be talking about today, which is a real differentiator for the company, all led by an experienced management team that's done this before. And we do take carbon neutrality and our path towards net zero very seriously and have been a sector leader in that space. I'll direct everyone's attention to the standard disclaimers and forward-looking statements, and we'll step right into it. So for those of you that are new to the story, Karora is located in Western Australia. It's where our mining operations and our head office is, in the Kalgoorlie camp, which those of you who are familiar with Australia will understand that's the most prolific gold mining jurisdiction in all of Australia. It's a tremendous zip code to be in. And if you look over on the right-hand side, you can see where our 3 primary assets are, as well as our 2 mills. So to the north, you have the Kalgoorlie Super Pit, which has produced 20 million ounces over its lifetime, and part of the Golden Mile, which has produced over 60 million ounces, which is just tremendous. St. Ives Gold Camp is further down the road, is 14 million ounces, owned by Gold Fields. And in fact, our new chief operating officer has just come over from the St. Ives Gold Camp, so it brings tremendous experience from them as well. Next to that of course, is our Beta Hunt mine and the Spargos open pit mine. And about another 65 to 70 kilometers down the road, you get to our Higginsville operations, where we have our Higginsville Central Mines, our Higginsville Centralized Mill, which is 1.6 million ton per annum mill. And if you go another 100 kilometers down to the south, you reach the Mount Henry deposit and asset. But that entire green shaded area that you see there is just under 2,000 square kilometers of tenements owned by Karora. That is, in fact, the largest land coverage on what's known as the Zaluka Shear, but to simplify it, basically the Kalgoorlie region. So Karora is the largest landowner in the Kalgoorlie region on the structure that hosts the majority of these very large deposits. So a wonderful place to be. And we've done some great work there over the past several years, and we're looking forward to producing more gold and, of course, nickel, as well as exploring this property as we move forward. As I mentioned before, we do take our carbon neutrality and our whole ESG principles very, very seriously at Karora. We're thrilled to be sector leaders in the junior gold space last year by becoming the world's first carbon neutral gold producer. We will be repeating that, of course, in 2022. And then moving forward, we'll be outlining some of the plans that we've been working on with respect to alternate power solutions, as well as some potential emissions reduction activities across our operations. On top of that, of course, we'll be continuing down the path that we've been leading with truly impactful carbon offset projects that we've been investing into alongside our partners at Invert, who've been helping us out with this initiative. So very proud to push that forward, and it actually has led to significant new investment from some very large institutions into Karora Resources. So it's translated into new investment dollars, as well as share price return. Certainly when we were enjoying that long streak, or I should say that positive streak earlier this year, late last year, before the market capitulated, a lot of that was led by our ESG initiatives. So certainly something that's worthwhile, and we get a lot of nods from other companies that are looking to emulate what we've done. In terms of the management team at the helm, everybody that's followed Karora for a while is very familiar with Paul Hewitt, who's our chairman and CEO. He brings a lot of experience that's very similar to what we've been doing at Karora to he brings a lot of experience from his previous role to what we're doing at Karora from a previous company called Klondex Mines, where he basically took over an orphaned asset in Nevada, tucked in some mills and as well as some other assets, and built a regional mining and milling center, which is exactly what we've done at Karora with the acquisition of the Higginsville Mill alongside Higginsville, pairing that up with Beta Hunt, stripping down some royalties and reducing royalties, tucking in Spargos, and then most recently, earlier this year, we acquired a second mill called the Lakewood Mill. So we now own 2 mills in the Kalgoorlie region, as well as several assets, and that's what's all leading to that growth profile that we talked before. So Paul's done it before. He's replicating the success here at Karora, and been executing very, very well. Over on the right is the newest addition to our team. Bevan Jones is the new Chief Operating Officer in Australia. Bevan comes over from the St. Ives Gold Camp, which he was running for several years and had a tremendous track record there, both with increasing production, decreasing costs, and increasing safety, in fact. So great regional reputation, has wonderful connections, is literally just coming across the fence. For those of you that are unaware, the Beta Hunt property is actually on St. Ives Goldfields property. It's a sublease. So a very familiar area for him to work in. He's admired the Beta Hunt asset from the other side of the fence for quite a while, and we're thrilled to bring him into the team. And he's going to be driving continued operational success and, of course, helping us grow and execute on that growth plan that we've laid out to the market. The prior Chief Operating Officer, or MD Australia, I should say, Graham Sloan, who everyone is very familiar with. We're thrilled, to continue to have him as a strategic advisor. Graham has stepped into a very well-deserved re-retirement, and we're thrilled to have his strategic direction going forward. So great transition for everyone involved. The remainder of the team is myself, the head of corporate development. Background is in investment banking and research, GMP Securities, as well, of course, as a mining engineering. Barry Dahl, the Chief Financial Officer, and Michael Doolin are 2 Klondex alumni that worked with Paul previously and are helping him replicate the success here, and have been executing very well as well. So stepping into our most recent acquisition, the Lakewood Mill, we acquired the Lakewood Mill earlier this year, and I've said this on a few other channels, but I'll reiterate it here. We had previously had a plan to expand the Higginsville Mill. We were going to increase the Higginsville Mill from 1.6 to 2.5 million tons per annum, and we laid out that plan in June of 2021 as part of our growth plan. What ended up happening over the course of last year and into early parts of this year, which will be certainly not unfamiliar to any mining investors that have seen dramatic capital cost increases across the sector, both due to inflation and supply chain constraints, as well as major disruptions, especially earlier this year with COVID-related impacts in Australia. We started to see the price quotes for that expansion increase significantly. So later last year, we stepped out to look at a bunch of different mills in the region, which we kept tabs on. And earlier this year, we were extremely pleased to acquire the Lakewood Mill, which is a 1 million ton per annum mill that is located, as you can see, very close to the Kalgoorlie region and close to Beta Hunt as well. And we acquired that for $80 million Australian. It was $70 million in cash, which we financed via an oversubscribed bought deal financing. It was well-timed and heavily subscribed by institutions. In fact, it was 100% institutions that filled that book, including one of our key cornerstone investors. So thrilled to have done that. And we closed that acquisition in July, got the keys for the mill in August, and you saw the impacts, obviously, in the third quarter, which we'll talk about here in a second, of owning that second mill in August and September, which led to a record performance for Karora. One other thing I do want to touch on while we are on this slide at Lakewood is that earlier this year in the first quarter, which was the high watermark for us in terms of costs, COVID had significant impacts on the mining operations right throughout Western Australia. Why the first quarter of 2022? Well, in fact, that was the first time Western Australia had been opened up since the pandemic started to basically free-flowing borders. Of course, it brought more labor with it, but it also brought COVID with it. So COVID spiked for the first time in Western Australia. We're really earlier this year, but we're really happy to have that behind us and those disruptions are over. We saw a significant improvement in cost in the second quarter, and then we expect that to continue into the third. The Lakewood Mill has a couple of benefits beyond the Higginsville Mill, which we were using previously for Beta Hunt material. Number one, it's 20 kilometers closer by road to Beta Hunt, so it costs you less to truck that material from Beta Hunt to Lakewood than it does to truck that material down to the Higginsville Central Mines. Number two, we actually get about 1% better recoveries at the Lakewood Mill than we do the Higginsville Mill, rather. And why do we get that? Because 100% of the feed goes through gravity circuits at Lakewood. So as we all know, Beta Hunt sometimes has the small pieces of coarse gold in it that come out in the stope. We truck that down to Higginsville. We don't necessarily get 100% of that recovered, but we do at Lakewood. So a tremendous advantage to putting that material through Lakewood. And of course, as we expand Beta Hunt, the excess will go down to Higginsville as we did before. We actually tried this before we buyed it, which is a great benefit to have. We toll milled 60,000 tons of material in the first quarter through Lakewood. Performed excellently. That was our signal to complete the transaction. So we moved it ahead, and thrilled to have that be part of our portfolio moving forward. This is our history of production, basically since the new management team came in and acquired Higginsville in the middle of 2019. Pretty self-explanatory chart there, basically continued delivery quarter after quarter after quarter. And of course, now we're stepping into quarter after quarter growth when it comes to ounces. But that was an important track record for us to establish to make sure that this company was delivering reliable quarters, reliable cash flow generation, continuing to attack costs and bring them down, which we did all the way through to Q4 2021. I mentioned Q1 of 2022 was a highly impacted quarter due to those COVID impacts. That added about $300 an ounce, in fact, in excess costs. You can see the second quarter, as flagged on this slide, was a 15% improvement. And, we expect a continued improvement moving into the third quarter here. We did report our third quarter production, which was a record for the company, 38,437 ounces. If you go back several years, this company was producing almost no gold. So that is a significant improvement. And hats off to the operations who've executed wonderfully through a very tough period. We certainly look forward to continuing to deliver strong quarters moving forward as we ramp up into that growth plan. We did benefit from approximately 2,400 ounces of coarse gold, which we press released earlier in this quarter. But even if you strip that out of the quarter, it was still a record quarter. So very well done to the entire team in Australia. This is our 3-year guidance that we've put out to the market here. We're on track. We've produced just under 100,000 ounces through 3 quarters. So we're very comfortable about that 120,000 ounce lower mark and the 135,000 ounce upper end of the range. On the cost front, we're continuing to deliver, and we expect to be well within that range of 1,100 to 1,200 this year. And then stepping out into 2023 and 2024, excuse me, you can see that ramp up to 200,000 ounces a year. And there's some interesting things we'll be able to do there, particularly with the nickel byproduct credits and their impact on all-in sustaining costs. In terms of the major sort of projects we have going on now, this is laid out on this slide. And, this slide 6 months ago, of course, had that Higginsville expansion on it. One of the important things about the Higginsville expansion is we actually completed that advanced engineering work in order to do the expansion. That is now shelved, it's tabled, but in further years, should we find significant sources of additional feed, in the later 2020s, let's say, we can always kick in that expansion as well, which obviously would provide us with even more milling capacity. So certainly future upside there. Of course, we have to find the tonnage and the ounces to feed something of that scale, but happy to have that optionality. Our focus now is really the second decline at Beta Hunt. That's how we're expanding that operation, and it's tracking very, very well. So if we step into Beta Hunt, I'll step into some of the discussion around that second decline and particularly the infrastructure that we have. But before I do, of course, 2 million ounces in resources at Beta Hunt. We continue to deliver ounce growth with every resource that we put out there, net of depletion, of course, net of mining depletion. We will have a new reserve coming out towards the end of the year at Beta Hunt, both in gold and nickel. So looking forward to delivering that to the market. But this asset continues to grow, and I'll be able to give you a better sense of that later on in the presentation when I start talking about some of the exploration targets and the new shear zones that we've been adding to Beta Hunt. But stepping into the infrastructure at Beta Hunt, and very quickly, those of you who've seen me present before will have heard this many times, but for those of you new to this story, one of the key factors for Beta Hunt is that it was a nickel mine for the better part of 30, 40 years before it became a gold operation. In fact, the nickel rights were owned, the gold rights were not owned. That's why the gold was never extracted there, while the nickel was. As a result of that, we have over 400 kilometers of existing underground development that's actually in place at Beta Hunt. You can see it on the schematic. If you can zoom in, you can see some of the dark lines there that show the infrastructure in place. At today's contract development rates, that would actually be just over $2 billion worth of infrastructure. So very, very significant. We get to leverage that, and we certainly have over the last couple of years, both with respect to extending resources and adding resources, but also with respect to mining and, of course, exploring virgin areas such as the new nickel areas that we've been targeting. So leveraging that existing infrastructure has been a huge advantage for Karora and is one of the reasons why we generate such strong cash flows at an average reserve grade of around 2.5, 2.6 grams per ton. So here's the second decline that we're working on. Happy to say that is just over 70% complete now. In fact, we got a bit of a head start on it late last year. We started attacking the second decline from underground with our own crews, so with our own development crews from the bottom side. Then on Valentine's Day, we actually started the development from the surface with contract miners. So basically, you're attacking it from both sides, and they'll both meet in the middle. So that's tracking very, very well. It was originally slated to be completed by about mid-year next year, I should say. But that's going to be completed in the first quarter of this year. Following that, you will get the beginning of development of the vent raise. So the ventilation raise needs to go into there next. That is the key factor or the key milestone to be able to increase activity underground at Beta Hunt. Right now, we are limited by ventilation at Beta Hunt. You can only get so much equipment underground with a certain volume of airflow, and only so many miners basically down there. So once that new ventilation raise is in, it's going to go all the way up to surface. That's going to allow us to do a lot more things. Number one, it will allow us to increase our mining rates, our development rates ahead of our mining rates for mining gold underground. It's also going to allow us to drill more aggressively, particularly for the new nickel areas. And then it's also going to allow us to develop the new nickel operation that we're going to be bringing into production off the back of the PEA that we put out just a couple months ago. So that ventilation really is critical, and that the accelerated second decline, getting that completed faster, means we can start the work on that second decline faster. So certainly tracking very, very well for us to be hitting that 2 million ton per annum mining rate at Beta Hunt by 2024. And if you actually look at what we did last quarter, we even exceeded half that rate with one of our declines. So certainly strong operational performance there. There could be upside to that number as well in out years. With respect to adding resources, so I'm not going to talk about each one of these shear zones here, but suffice to say, since mid-2019, when we really started, exploring at Beta Hunt, and certainly since early 2020, when we unwound, or I should say, reduced that Mavericks royalty at Beta Hunt, we have discovered 5 new shear zones at Beta Hunt. So we've discovered Mason, Cows Hill, we've extended Fletcher, we've discovered Sorensen and Western Flanks North and A Zone North. So it's actually a tremendous amount of success we've had via the drill bit. And of course, the Larkin, I shouldn't forget the Larkin. We'll talk about that in a slide or two here, which is now 300,000 ounces in resource. So unwinding or reducing that royalty significantly at that point in time is what allowed us to be very aggressive with the drill bit. We spent about $20 million each year across our property on exploration, but that has really turned into drill bit success here. And if you start doing the math on all those ounces that we've been adding via the drill bit under the previous royalty regime, would have been dramatically different for shareholders than the royalty regime that we have right now. So a very strategic move at a point in time, and it's certainly paid dividends for us over the course of the last year and a half, 2 years, as we've continually expanded this resource. This is a cross-section of the Larkin. It's been in the slide deck for quite a while. We can keep it in here because it's a perfect representation of how you have these nickel pods or nickel troughs that sit right on top of these gold areas. In fact, there isn't a single known occurrence of nickel or gold that doesn't sit on top of each other like this at Beta Hunt. So everywhere you find nickel, you find gold. Everywhere you find gold, you find nickel, which is a great, obviously, opportunity for us to increase byproduct credits on the nickel side. So we, from first drill hole, post winding down of that royalty, right through to initial resource, was 18 months, just 18 months. No dollars spent on development, only on drilling, all from existing infrastructure. Again, another tremendous benefit of that 400 kilometers of infrastructure at Beta Hunt. Stepping into the nickel here, we put out a nickel resource we updated earlier this year, just about 33,000 nickel tons in total, or nits as they call them in Australia. The grades are tremendous, 2.8 and 2.7%. About a third of that resource, roughly speaking, is in the new 50C zone, which we'll talk about here in a second, which is really the focus of our PEA. But there is tremendous upside for expansion of this nickel. And if you look at that schematic on the left-hand side there, from that gamma fault, which is labeled in black there, to our property boundary is 2.6 kilometers. We have drilled about 800 meters away from that gamma fault with existing infrastructure. We cannot go further until we have that ventilation raise in place. So again, that's why that is so critical. Once we have that in place, we'll be able to step out even further along that trend to extend the resource. The resource is shown where those green boxes are, but we've only drilled 800 meters of 2.6 kilometers worth of potential strike extent. And if you look at everywhere else in the operation, these nickel troughs, and of course the gold shear zones underneath them, continue until you hit a major fault. We do not know of another major fault between the gamma fault and our property boundary. So a very good case for that continuing on all the way to the property boundary, which of course would be tremendous for future nickel production. On top of that, we have a wonderful validation hole, a historical surface drill hole that's labeled on this slide here. It was 9.5 meters of 11% nickel. That is directly on trend with where we expect those nickel troughs to continue, right in line with our existing resource. So, and that's about 400 meters away from the southernmost extent of our existing resource. So, a potential validation that nickel continues. We're very, very excited about it. Obviously, there's a lot of reasons to be excited about nickel these days, but that is a potential game changer for the company, of course, on top of the gold that we already have. In terms of the continued success with drilling some of these targets, we're also finding success north of that Gamma Island Fault, which is where we're currently conducting some remnant nickel mining. So just about a month and a half ago, we press released this hole, 12 meters at 6.5%, just 25 meters away from existing development. So nickel in many places at Beta Hunt, very close to existing development, which means we can mine it very, very shortly or very, very soon. One of the advantages we have with our nickel is we do not need any nickel processing facilities. We have a contract with BHP, who've restarted their Kambalda concentrator just 4 kilometers down the road from Beta Hunt. Everybody knows BHP has signed an offtake with Tesla for green nickel. We are now providing high-grade carbon-neutral nickel to BHP, which is a product that they have very, very strong demand for. So suffice to say, anything we can mine in terms of nickel from Beta Hunt, we have a very strong buyer there. So great position to be in, and we don't need any processing facilities. This is a summary of the PEA that we put out earlier, but probably about 2 months ago now. Just in terms of talking about some of the metrics here, I'm not going to go through all of them, but one thing I do want to flag is the incredibly low initial capital investment. Just $7 million is required in the first year of production for the nickel projects, actually pre-development, I should say. That is incredibly low. You will not find another nickel project in the world that has a upfront capital number that is that low. Why is it so low? Again, because we are sharing all of that infrastructure. We're already there. We're going to be using the same infrastructure for mining gold. So over an 8-year mine life, you're only spending about $19 million in development. It is astronomically low for the kind of nickel production you're going to be getting out of this, which is over 10,000 nickel tons, or just under 10,000 nickel tons over the 8-year mine life. As I'm sure you can guess, we expect that to continue to grow with continued exploration. And you're going to be looking at byproduct credits, starting at a base case level of around $100 an ounce. Certainly, if you flex it to higher nickel prices, it could go much higher than that. With respect to other areas that we're targeting, I talked about that resource continuing to expand. We talked about that strike extent south of Gamma, but many other areas such as the 4C and the 44C we just talked about, and other areas in northern parts in the mine as well. So lots more nickel to come at Beta Hunt, which can drive obviously significantly lower, or I should say higher byproduct credits to lower overall all-in sustaining costs. So the better nickel does, this story certainly has leverage to the success of the nickel price, which of course, given the heritage of the company, is wonderful to maintain. With respect to Higginsville, I'm going to jump through Higginsville and Spargos fairly quickly here. I do want to leave some time for questions. At Higginsville, we continue to mine from a couple different operations at the Higginsville Central area there. We are mining at Aquarius and Two Boys, which are two of our new underground operations, smaller operations, but delivering great grades to the mill, which complement that Beta Hunt feed. When we reach the expanded rate at Beta Hunt, you're going to be doing 2 million tons from Beta Hunt. About 500,000 tons for our milling capacity will come from the Higginsville Central area, and of course Spargos. So a smaller part of the story, but important nonetheless, and we continue to track well there. Of course, Spargos is the open pit mine that we acquired for just $4.5 million in 2020. It's delivered wonderful results for us, and there will be an underground operation there eventually. We are evaluating that right now as we speak. With respect to where we are in the market, look, everybody knows the misery we've experienced over the last, call it 6 months. Broadly speaking, in the sector, everybody has reverted to the mean, and we're all trading at the same, basically, P/NAV multiples and P cash flow multiples, down below 500 million is what I should say. Where the 200,000 ounce a year peer group is trading is just north of $1 billion. So again, potential double from here, but reversion to the mean on valuations. Basically, nobody has been left unscathed. We had a great run earlier this year. We made shareholders a lot of money, which is wonderful, and we fully expect to be doing that once again. So that's just a summary of who covers us, but I do want to pop over into some of these questions here. I see we just have 5 minutes left, so I'll try to rattle through them, as many of them as I can, as quickly as I can. Okay, let's go to the first one. Okay, so the first one is, can you share any goals with regards to resource resource updates in the medium term? How many years will resource growth with similar quality be bigger than the 150 to 200,000 ounces of production? Okay. I think what you're asking there is what are we targeting in terms of mine life is probably the read through what I'm getting there. Look, we have a mine life right through to the late 2020s right now. We certainly believe we'll be going for much longer after that. If you listen to our chief geologist at Karora, he thinks this is a multi-decade mine. We keep adding those shear zones, we keep extending them, and we have lots and lots of strike length open to the property boundary. They're also all entirely open at depth, so lots of resource growth to come. After a strong operating performance in Q3, is it safe to say the COVID impacts on the operation are behind us? Yeah, I mean, I'm not an epidemiologist, of course, but when it comes to COVID, those waves seem to have gone through Western Australia, kind of right where the rest of the world is now. We're certainly seeing that absenteeism drop down. Still a tight labor market, as it is everywhere in the world right now, but happy to say that initial wave is certainly over us. Okay. Next question here. Record Q3 production was great news, and the fact that it would still have been a record quarter even without Coarse Gold contribution of 2,400 ounces is very encouraging. Could you provide more color on Coarse Gold occurrences and how it impacts costs? For example, are these considered almost free ounces? Okay, so that's a good question. So we do know where we know the region or the area in which they occur is where the sedimentary band cross-cuts those shear zones. Of course, as we've said many times before, we take all of our stopes in sequence based on geotechnical considerations. We are an open stoping mine, and for anybody that understands open stoping, there's a very careful redistribution of stress regimes that you need to manage an open stoping mine. So we take them in sequence with how our geotechnical engineers tell us to extract them. And of course, we do have to leave pillars for support. But when we're in that area, we know that there's potential for it. We are thrilled to have that 2,400 ounces earlier this quarter, which contributed to our record quarter. But nevertheless, we expect to have more of them in the future, particularly when we're in that zone, and we'll always watch out for them. Okay. Alongside Karora's growth plan to increase gold production over the next few years, you have aggressive plans for increased byproduct nickel production. Could you comment on how this differentiates you from your peers? Yeah, it's a good question. So in terms of differentiation, there probably isn't, at least not that we're aware of at this point in time, another primary gold asset in the world with a nickel byproduct credit quite like this. There's lots of polymetallic byproduct credits. Of course, we see copper gold deposits and gold copper deposits and gold silver. You see, sometimes gold, silver, lead, zinc. It's particularly in Western Mexico, but you never see gold with basically primary gold with I should say nickel like this. So it really is a differentiator, and obviously we're pushing that whole sort of carbon neutrality, green transition arm of the business. The nickel is just becoming more and more and more valuable. We are a gold company. We're focused on that gold, but the nickel certainly is exciting. So we're appealing to more than one investor base by having both of those available to investors. So we'll expand both avenues, but it certainly is something that, particularly over the last couple of months of marketing at conferences and individual, institutional investor meetings, we're getting asked about more and more and more. Okay, I think I've got about 45 seconds left here, but I will take one more question. Okay. Do you fear being taken over given this very low valuation? So I wouldn't say fear is ever a word. Look, everybody has reversed, I should say, reverted to the mean. So valuations have kind of traded to bring a lot of companies in line with each other. We are seeing some consolidation in the space, but not a lot. Obviously, we'd like to continue to execute on our plan and get that valuation back up. But you're going to have to see a lot of macro events change in order for the gold sector to kind of retrade to where it needs to be. So our focus is absolutely keep our heads down, execute on this plan, both with respect to gold and nickel, deliver value, keep delivering ounces and cash flow to the balance sheet, and execute that strategy, and we'll see what happens next. So that's it. I think I'm out of time, and thank you very much.